A bond can pay the exact same coupon tomorrow and still be worth less in the market today. That sounds like a contradiction until you separate the payment printed on the bond from the price another buyer will pay for it. Watch the quote get compared with the cash payment. The moving number is price, not the coupon. Stay with us because the useful part isn't just the famous inverse relationship. It's why a number called duration can make two bonds react very differently to the same rate headline.
The coupon stays put. The market price doesn't.
In our dividends episode, we separated a payment from the story investors tell around it. Bonds ask for the same discipline. Start with the contract, then look at the market around it.
Say I own a $1,000 bond paying $40 a year. Its coupon is 4%. If newly issued comparable bonds start paying 5%, a buyer has little reason to pay full price for my 4% cash flow. The price has to adjust until the older bond is competitive. Watch the newer rate appear beside the older cash flow. That comparison is what changes the resale price.
So the issuer didn't suddenly change its promise. The resale price did because the alternatives changed?
Exactly. Investor.gov describes the general relationship this way. When market interest rates rise, fixed-rate bond prices fall. When rates fall, prices generally rise. That's interest rate risk, not a prediction about next week's rates.
And don't let a single word called yield do three jobs. Coupon is the stated annual interest rate. Current yield uses today's price. Yield to maturity is a hold to maturity calculation with assumptions baked in. Read which one a screen is showing before you compare anything.
Liam, take the $4 example one step further. If a bond still pays $40 a year, but its market price has fallen from $1,000 to $800, the cash payment did not grow. Yet current yield becomes 5% because 40 divided by 800 is 5%. That arithmetic can be informative, but it doesn't tell you by itself whether the issuer will pay, whether the bond can be called, what taxes apply, or what happens if you sell tomorrow.
So a higher displayed yield can be a consequence of a lower price, not a prize sticker. I can see why that gets dangerous when a screen puts the percentage in huge type and the reason for it in tiny type.
Exactly, Liam. Ask what changed and who is taking which risk. A bond priced below par may simply be aligning an older coupon with newer rates. It may also reflect concern about the issuer or thin trading. Those are different stories, and a quote alone can't tell you which story you're buying into.
Yield to maturity adds another layer. It is a calculation based on buying at a particular price and receiving the scheduled cash flows through maturity. It is useful for comparison, but it isn't a promise that every assumption will hold. If a bond is callable, sold early, or defaults, the path can change. Treat the label as a question about assumptions, not a conclusion.
A quote can also be harder to exit than a stock quote makes you expect. Some bonds trade less often, and the price available when you want to sell can differ from a headline reference. Ask a broker how a price was determined, whether it's a bid or an offer, and what transaction costs or markups are involved. I'm not saying every bond quote is suspect. I'm saying the mechanism belongs in the file before the money does.
That makes the basic map. Fixed coupon, moving market price, and several yield labels. The arithmetic isn't the hard part. The hard part is refusing to let one label answer a question it was never designed to answer. If you need to sell early, what price risk can you actually carry?
One more distinction keeps the vocabulary from doing damage. Par value is the amount scheduled to be repaid at maturity under the bond's terms. Market price is what a buyer and seller may agree on today. A bond can trade above or below par. Neither word, premium nor discount, tells you whether it belongs in a particular account. They describe price relative to face value, and the rest of the analysis still has to happen. That question takes us to the desk, because duration is the label people often mistake for a calendar date. Let me pause for just a second, because this genuinely helps. If you are getting value here, hit that like button, then subscribe and ring the bell. It costs you nothing, and it is the single biggest thing that keeps these videos coming. Professor Havel is here to help us turn that label into something a real person can inspect before acting.
My first guess was duration just meant maturity. How many years until the bond pays back principal?
Close enough to cause trouble. Maturity is a date. Duration is an estimate of how sensitive a bond investment's price may be when interest rates change. It uses cash flow timing, yield, coupon, and, where relevant, call features, not just the final payment date.
Give us a clean scale, not a magic number. Watch the payment dates collect on the page because their timing is part of the calculation.
FINRA's practical illustration is useful. Duration 10 means a 1 percentage point rate increase would be expected to lower price by roughly 10%, with the direction reversed if rates decline. Approximate is the operating word. Curves can move unevenly. A bond can have other risks.
Professor Havel, this is where people can overread the example. A 1 percentage point move is a measuring stick, not a forecast. And rates aren't a single switch. Short, intermediate, and long market rates can move by different amounts. The duration figure gives a first-order sensitivity estimate. It doesn't recreate every trade in a live bond market.
That is the useful limitation. Duration helps compare exposure to a stated kind of movement. It doesn't say an investment will move exactly that amount, and it says nothing by itself about whether the borrower can pay. A clean metric becomes misleading when viewers quietly promote it into a complete forecast.
So duration 10 isn't saying lose 10%, it's saying this has a larger rate sensitivity dial.
Right. Think of it as a sensitivity label. Higher duration generally means a bigger price response to a given rate move. It doesn't award safety or danger by itself.
What tends to move that label? If two bonds both mature years from now, why would their sensitivity differ? Before we get to the final worksheet, keep that limit in view.
Cash flow timing matters. In general, a longer maturity tends to raise duration, while a higher coupon tends to lower it because more cash arrives earlier. Yield and call features also matter. That is why maturity is a clue, not a substitute for looking up duration. You don't have to calculate it by hand to ask whether the published figure matches the exposure you think you're taking.
There is a second reason the distinction matters. An investor can be right about the direction of a rate move and still misunderstand the magnitude or timing of a price move. Duration is a compact way to make that uncertainty visible. It lets you say, if rates move, this holding may be more sensitive than that one without claiming to know tomorrow's path. That is a much better use of an estimate than turning it into a trade instruction. Watch the fact sheet lines being checked. The as of date belongs beside the duration number.
Professor Havel, if I'm reading a fund fact sheet, I want the date next to duration too. A stale statistic can make a neat comparison dishonest. I also want to know whether the manager is using derivatives, which sectors dominate, and whether the fund's objective permits changes. The label opens the folder, it doesn't close it.
That is fair. Duration is often reported as a portfolio statistic, and portfolio statistics evolve. A fact sheet or prospectus can provide context, but the reader should check its as of date and understand that the number is descriptive, not a personal recommendation. If the decision hinges on a specific security, asking the broker or advisor to walk through the current terms is sensible.
And it definitely doesn't erase credit risk. A borrower can be less able to pay. A callable bond can be redeemed when reinvesting is inconvenient. A fund can have expenses and changing holdings. One pleasant duration figure can't cross-examine the whole contract for you.
If you remember one sentence, use this. Duration describes one important kind of price sensitivity. It isn't a complete risk grade.
I am keeping the words separate now. Maturity tells me when principal is scheduled. Duration estimates price sensitivity. Yield describes return through a particular formula. The fact that those words often appear beside each other is not permission to use them interchangeably.
Thank you, Professor Havel. That distinction keeps the next step honest. Use duration to ask a better question, then inspect the rest of the bond or fund.
Okay, I've got Caroline's sensitivity label. What do I do with it without pretending one chart tells me what to buy?
Start with timing. Market price movement matters differently to a person who expects to hold an individual bond to maturity than to someone who may need to sell it, and funds don't mature as a single bond does.
That fund point deserves a pause. A bond fund can own many bonds and replace them as they mature or are sold. So I should not look at a fund's duration and imagine a personal date when the whole thing hands me principal back.
Yes, a fund's stated objective, holdings, turnover, costs, and duration are all part of the picture. Its duration can change as the manager trades or as time passes. Individual bonds also have their own complications: call terms, liquidity, and a quoted price that may be based on dealer markets. The educational move is to identify which vehicle you're actually evaluating before borrowing rules from the other one.
Before someone says short duration equals safe, stop. Safe from which problem? Lower rate sensitivity can coexist with credit, inflation, liquidity, reinvestment, or fund structure risk. And a high yield isn't an exemption from that checklist. It may be compensation for risk. Read whether the issuer is government, municipal, corporate, or something else. Read the documents. Then ask what you would need to be true for the expected cash flows to arrive. If someone sells you certainty using only a yield chart, the missing column is the product.
For a practical comparison, write down what is comparable and what is not. Two funds with similar names may own different credit qualities, maturities, countries, or sectors. Two individual bonds with similar yields may have different call provisions or liquidity. A lower or higher number isn't a verdict without the sentence around it. This is where slower reading isn't caution theater. It's how the labels regain their meaning.
That is a much less comforting label. Watch the decision notes become questions before any order is considered.
It's a more usable one. For a bond fund, find the reported duration in its materials, then read what the portfolio owns, how the manager defines its objective, what the costs are, and how the fund has authority to change. For an individual bond, read the offering terms: coupon, maturity, yield, call features, credit information, and how a dealer's price is quoted.
Ask for the full row, not the shiny column.
And taxes can change the comparison too, right? A quoted yield isn't automatically my after-tax result.
Correct. Tax treatment depends on the security, account, jurisdiction, and your own facts. That's a conversation for a qualified tax professional, not a blanket claim from a video. A broker or licensed advisor can also help explain a specific bond's pricing, liquidity, and risks before you transact.
My practical worksheet would be: what cash flows am I being shown? What yield label is this? How much rate sensitivity is reported? What other risks remain, and when might I need the money?
That is a strong starting worksheet, Liam. Add the source of the quote and the date you saw it. Then, if a real decision is on the table, bring the terms to your broker, advisor, or tax professional and ask them to explain the trade-offs in your situation. Education should make that conversation sharper. It can't replace the suitability work behind it.
And keep the questions in writing. What is the coupon? What yield am I looking at? What is the duration and as of date? Is it callable? What is the credit story? How liquid is it? What costs and taxes belong in my comparison? A good professional should be able to explain those plainly. If the answer is a slogan, you have learned something important before committing. One last check. Can you explain what would make you sell? If not, don't let a yield number make that decision invisibly for you.
None of this requires guessing where rates go next. You can understand the inverse relationship and duration without making a directional call. The productive question is conditional. If rates, credit conditions, or your own need for cash change, what could move and what document tells you that? That approach is less dramatic than a forecast, but it gives you something verifiable to carry into a real conversation.
And it gives you permission to pause. A percentage is not a deadline.
If this clarified the vocabulary behind a bond quote, like the video and subscribe for the next Investing Explained lesson. When you compare a bond or bond fund, which risk will you check before yield? Thanks for learning with us. See you in the next one.